Okay, so good evening, everyone, once again. Like we said yesterday, it's not just about the standards and the number, it is about, decoding a global language of business. And honestly, I mean, it is every time it is good to hear on the IFRS Satya Bharat and the Ravikant as well. And I will not take much of the time. Honestly, we are going to start from where we left off, more insights, more discussion. But yes, before that, it's time to listen our one of our dynamic leader. We unfortunately couldn't join yesterday. So, Rishi bhai, your thoughts on the session on the IFRS? You want to say something? Over to you, Vice Chairman CA Rishi Chawla.
Thank you, first of all. Thank you, Amit Bhai, Secretary Saab, Chairman Saab, Jayaprakash Agarwal, Treasurer Ji, Ashna, and all our members, and our Satya Bharat, and our the speakers who have taken the time out, especially on a weekday in the evening, and that too like 3 days in a row is not an easy thing to do, and that too to deal with a subject such as IFRS 9 is not an easy one. So definitely, first of all, congratulations to you that you have got such a great grasp on this subject, that you have got the material and that kind of practical examples to share with us. Thank you very much, appreciate it. And to all our members, I need for taking time to come out and spend time on this quality standard, because IFRS 9, trust me, like I've been an auditor with Big Four and all that all my time. Every time a new standard comes, it brings new problems, new questions, new queries, and like expected credit losses is one of the area which actually took a lot of time to convince the client even why this standard, what it is going to do, and how it is calculated itself. So I think thank you very much for all our committee for being enthusiastic all the time to bring such a session. So I just like to say, please continue to share knowledge and ask more questions, because this is a practical standard, not a theoretical one. More questions, you get more practical answers. So with that, let's continue into the session. Secretary Saab, thank you very much.
Thank you so much, Rishi bhai, for that crisp and the brief address. And let's not, take more of the time, because IFRS and all this focus group, we just, want to keep it focused on the knowledge sharing. So I will just directly request to our one of the speaker, CA Ravikant. He is going to start today. So over to you, CA Ravikant, to take it forward from here. So let's buckle up and make the most of the sessions. Thank you from my side.
Yeah, thank you, committee, and thank you, Dubai ICAI, for this opportunity. Yeah, I mean, today's agenda, let's get into the subject without wasting any time. So today's agenda is going to be, as planned already, reclassification of financial assets. At the same time, derecognition, basically, derecognition of financial liabilities and derecognition of financial assets. At the same time, the interesting and maybe little difficult topic, that is impairment of financial assets, which is nothing but ECL. Okay, these are going to be covered. Before getting into these new topics, I mean, new topics of IFRS 9 and IS 32, right? Our Satyabharat is going to give some 10 to 15 minutes of recap of yesterday's subject. That will be adding a lot of value to us. So over to Satyabharat.
Yeah, thank you, Mr. Ravi. Hope my screen is visible.
Yes, it's visible.
Okay. So, as a quick recap of the discussion what we had yesterday. So we initially started with discussing on the definitions for the financial assets and financial liabilities, and we have seen like around 4 financial assets and 2 financial liabilities with subparts in that, and we have seen multiple illustrations, including embedded derivatives. Then we move to comparing with the non-financial assets and non-financial liabilities. We have especially our interest in this discussion was about the initial measurement, subsequent measurement, and off-market adjustments. If you take any of the non-financial assets and non-financial liabilities, the day one, the initial recognition is generally at cost, with few exceptions like biological assets. Right to use of asset also, it's a cost, but the cost which you are going to incur in the future, the lease payments what you are going to pay in the future. So more or less it is a cost what we take on initial measurement. Again, the subsequent measurement is given the reporting entity has got a choice to choose to go with the fair value model or to go with the cost model, wherever it is given. So the choice for the subsequent measurement is mostly given to the reporting entities. Then our discussion was on off-market adjustments. As and when there is an off-market transaction, meaning, for example, the one reporting entity purchased PPE from another related party, but not at market value, less than the market value. No adjustments required for the IFRS purpose. Maybe we require to make adjustments for the corporate tax purpose. So these are the core points we have initially discussed from the non-financial assets and financial liabilities. Then, but unlike this, the choices are not given when it comes to the financial instruments because it is rules driven, meaning you have to conduct a particular process. The results of the process will decide how your subsequent measurement going to be. And initial measurement is decided already. There is nothing that we can take a call. So we will see 4 different scenarios of the financial assets. So it all depends on your business model. The purpose of you holding this financial asset, what is the reason? Is it your model to take to collect the complete contractual cash flows? So any financial assets give you cash flows. So is it you want to hold this asset and you want to collect the entire contractual cash flows by holding it till maturity? Is this what your business model? Or is it your business model is to hold, but you also have an intention to sell and make profit? So do you have both the kind of objectives in your business? Or the third one, the purpose itself is to sell the financial asset and make the money, or it's an equity instrument. So they have given some residuary. All those which will not belong to the first category and second category by default fall under third category. So this is the first level business model, first business objective we will understand. And the second test is going to be what kind of cash flows you are getting. You have a financial asset, but what is that you are going to get from this particular financial asset? Is it only the principal and interest? It should not have any components like capital gains, dividends. If it is giving you only principal and interest, then you can say my first type of instrument is subsequently measured at cost. Subsequently, not the day one. I repeat, this is not for the day one, not the initial recognition. We are talking, the classification is for the subsequent measurement, meaning all those type of first kind of financial assets will be subsequently measured at amortized cost. The second style of financial assets will be subsequently measured at fair value through OCI, reclassified, and the third type will be fair value through P&L. Hope everyone remember this was the discussion what we had yesterday. However, not everyone will happy with the third category, especially when you have invested in the subsidiaries, because investment in equity shares will come under the third category. That such financial asset will come under third category. So any future movements, future fair value fluctuations, not everyone interested to take it to the P&L. They don't want to disturb their P&L. So for that reason, there is an irrevocable exception given to third one, where you can choose an irrevocable election you can make. This is exclusively for the investment in equity instruments. It can be subsidiaries, associate, whatsoever. Equity investments can be always, you can take a choice, which is irrevocable. And any fair value adjustments in future, subsequent measurement can be routed through fair value through OCI. Clear so far? So this was the discussion what we had yesterday. This was just to understand the first level. But the day one, the initial measurement has to be at the fair value. It has to be at the fair value with a small exception. What is the exception? If this financial asset is a trade debtor with no significant financing component, or this is a financial asset or liability with a demand future. These two type of instruments, you can go with the amount, the transaction price, meaning your regular, what are the cost incurred or what are the transaction price you can show. However, transaction cost has to be capitalized to it, initial measure. But rest all the cases has to be at the fair value. Be it amortized, classified under amortized cost also should be at the fair value. But only thing is transaction cost has to be capitalized. Am I clear so far? So the fair value, that is the deciding factor. Day one has to be the fair value. What if a situation happened, and it is most common that your transaction price can be different from the fair value? In such cases, how I should account it? my fair value will be different from the transaction price. The said difference, you have to take it to the asset or P&L. But before that, there was a question. One of the participant asked me how I will get my fair value. Hope you all remember the fair value for the IFRS. For the corporate tax, we may be doing the benchmarking, but for the IFRS, there is a separate standard given by itself, which is IFRS 13 fair value measurement. This fair value measurement IFRS standard has given some 3 levels of hierarchy. You follow the hierarchy. In whichever the level you will get, you take that input as a fair value. The first level, the instrument, what you have in hand, the financial instrument, is it a quoted instrument? Can you get the value of this instrument immediately in the market? Is there any observable inputs? If it is so, you call it as level 1 input, the first one in the level of hierarchy. If this particular instrument has a immediate quoted information, you take it and you call this as a level 1 input. Otherwise, just go to the level 2 or level 3, wherein you calculate the present value of the cash flows. I repeat, from where will I get the fair value? It is given via IFRS 13 fair value measurement. The fair value measurement, to summarize, it has given a hierarchy of obtaining the fair value. The first one, the level 1, is if the instrument itself is a quoted instrument wherein the market value is immediately available, take that and assume that it has a fair value. If not, then go and do your own assumptions, calculations, and make a present value of the future cash flows. So 2 levels. Now, excellent. Thank you. So the fair value, this will decide your difference between your transaction price and fair value, how you need to account depending on from where you got this input. Meaning, if you got your fair value from a level 1 input, you will be directly, what are the difference? Now, hereafter, I'm going to talk about only the difference between the fair value and transaction price. Fair value and transaction price difference, how we are going to account. If it is from level 1 input, sorry. If it is from level 1 input, then immediately the difference immediately will be taken to the P&L on the day 1. The day 1 of you purchase, you got this asset, the day 1 itself, you will take the entire difference to the P&L. If because of any other reasons, there is a difference between fair value and the fair value you have obtained through level 3 input or level 2 input, then the difference either you will capitalize or you will be taken to the P&L, depending on its qualification. And for this, we have seen multiple scenarios. So I'll just take you through the summary of the scenarios what we have seen yesterday. Sorry. One second. Okay. So these are all the summaries. Now, this table is exclusively, we are discussing about the difference between the fair value and the transaction price under different scenarios. The first scenario we already discussed. If it is because of a level 1 input, it will directly hit the P&L. If take another scenario wherein the lessee giving a security deposit to the lessor with 0%. Obviously, generally security deposit will not carry any interest. In such case, this financial asset, the receivable from the lessor, is a financial asset in the books of lessee, which is not carried at the market standard. There is no interest on that. So you will calculate the present value of the receivables. So the difference between actual amount, what you paid, the transaction price, and the present value, the difference in the case of lessee, he will recognize and show it as a right to use of asset. And in the case in the books of lessor, he will recognize it as an advance lease rentals, which he has taken. So the right to use of asset will get depreciated over the period. Similarly, advance lease rentals, he will also recognize as an income across the period of the lease tenure. The next scenario, wherein an employer giving loan to employee for 0 interest. The employer will recognize the difference between the present value and the actual loan given as prepaid employee benefit expense, while, of course, employee will not have any books. And this is the interesting part. A shareholder, a parent company giving to subsidiary company interest-free loan, then the shareholder, the parent company, will recognize the difference between the transaction price and the present value of the future cash flows as investment in subsidiary, and it will capitalize to the investment. So already shareholder invested some, say for example, 500,000. On top of this 500,000, he will add the difference as if it's an investment. It's a new investment in the subsidiary, while the subsidiary will show this difference as a capital contribution from the owner. This will be continued ever. This will not be taken to the P&L. This will be continued ever as long as the holding company holding the subsidiary. And vice versa case where subsidiary giving loan to the parent company. In such case, the difference in the books of subsidiary will be adjusted through retained earnings, while the shareholders' books it will be recognized as a dividend income. Between sister concerns, the company which is lending the money will recognize an expense because it is given for free of cost. So there is an implied cost. So that cost, the implied cost, whatever the difference between the transaction price and present value, will be recognized as an expense in the books of lender, while the borrower is getting it cheaper, getting for free of cost the loan. So that different, what are the benefit it is going to get has to be recognized as an income. But overall, if you see, if you take, we have seen in the illustration yesterday, but if you take up the entire tenure, the impact will on balance sheet and P&L will be zero. On top of it, once we comply with IFRS 9 requirements, we have as good as complied with the transfer pricing regulations for the corporate tax. Because we have seen yesterday the definition of fair value. Fair value definition is no less than an external cup method. Okay. So then, so far we are discussing all these things. Whatever we have discussed is for the day one initial recognition, initial measurement only. All these adjustments to be done on the day one of having the instrument. Subsequently, as and when any further fair value changes, we will see now. Subsequent movements, for example, fair value changes, the year-end fair value changes. In the case of amortized cost, we don't care because it's not subject to fair value. However, in other cases, for example, if you take fair value through OCI, the fair value movement will be recognized in OCI and later it will be taken to other equity. Same is the case with the third one, exception to 3, where equity instruments designated to OCI. The movement will be captured in OCI and the fair value to P&L in P&L. Impairment gains and losses in all the cases to P&L, and instruments which are subject classified under fair value to P&L not subject to impairment accounting. So we will not do. Regular incomes in the case of amortized cost, everywhere it is P&L. However, keep in mind like those assets which are subject to amortized cost, the calculation of interest should be not straight plain vanilla. You have to use the effective interest rate method for calculating the interest expense or interest expense on this. Realized gains, generally it is P&L, exception, the fair value through OCI, non-reclassified. Only this is the exception where it has to be routed through OCI. Hope that is visible to everyone. Yeah, so this is what we have seen yesterday, initial measurement, subsequent measurement, and how to account for the difference between the transaction price and the fair value. So that's all from my side. Over to you, Mr. Ravi. So you can take it forward on the derecognition and impairment process. Thank you.
Yeah. Thank you, Satya. Thanks for the quick. 1 second. Thanks for the quick and beautiful recap. That's obviously very helpful for the participants to get back to the original, where we stand exactly. Chalo, let's focus on today's topic, which is going to be, like, as I said, reclassification of financial asset. As we have just seen right now, the classification we have understood. I think, voice is clear?
Yes.
Does that sound everything clear?
It's perfect. Everything is clear. Go ahead, please.
Thank you very much. So we have understood that initially every financial asset and financial liability is going to be recognized at fair market value. In case of if there is a transaction cost, if it is a FETPL classification, it will be charged to P&L. In case of FETOCA or amortized cost, it's going to be added, right? That is to be added. And in case of financial liability also, if amortized cost, same, plus or minus is going to take place, right? Now, classification is happening based on the business model and SPPI test. I say that is a characteristics of contractual cash flows. SPPI is nothing but solely payment of principal and interest. Correct. So now reclassification. So once we understood the classification, then only we can understand the reclassification better. Right. See, the heading is reclassification of financial asset. Then what about reclassification of financial liability? Not applicable. Why not applicable? Financial liability, all the financial liabilities are going to be classified as at amortized cost, subject to one case it can be of FVTPL. That also should happen at initial recognition and irrevocable option. That means if it once you classified as FVTPL subject to some conditions, okay, then it cannot come back to amortized cost. So that's why there is no reclassification with respect to financial liabilities. So it is only for financial assets, right? When should I do it? Is that when my intention changes, I should reclassify, right? If my intention change, shall I reclassify it? No, not when your intention changes, when the business model changes. Then your objective, your goals, correct? It is not supposed to be like intentions. It is supposed to be demonstrated. The significant change business model from business model 1 to 2 to 3. Okay, under that circumstance only it is supposed to take place. And I said it is demonstrable, not just intentions. Okay, at the same time, this is generally, it won't happen like so frequently, and this is has to be this, the business model change cannot happen at a accountant level or somebody at a down level. Obviously it has to take place at very senior management level, right? Only under that circumstance reclassification can happen under these three circumstances: where my intention is changing, where temporarily there is no market for my financial asset, or the change in the cash flows realized compared to expectation. No, under all these circumstances, it does, I mean, you are not eligible to reclassify your financial asset. Okay, right. So how is the reclassification? Okay, sir, from amortized cost to I'll go to FETPL, or from amortized cost to I'll go to FETOCI, or FETOCI to amortized cost, FETOCI to FETPL. Correct. So there will be totally 6 circumstances that are possible, right? How the reclassification will happen? Are we supposed to go back retrospectively? Are we supposed to apply, or is it going to be only prospective application? Right, very clear information. It is going to be only prospective, no restatement, no retrospective application is applicable. Done. And the next one more thing is the assessment. Correct. Now the asset is measured whenever you wanted to reclassify. Which day are you supposed to reclassify? Which day business model is changed and that is approved by the high level senior management people? That day it is supposed to be reclassified. So on the date of reclassification, what should I do? The first job, what is the fair value on the date of reclassification you are supposed to determine. Okay, so all right, now in the given case, Ravi, my book value is something that is a carrying amount, but today the fair market value what you are determining on the reclassification date is something different. So what should I do that difference, plus or minus? That should I transfer it to P&L or shall I transfer it to OCI? That depends on the future classification. You are moving from where to where, that is important. Suppose I am moving from FETPL to FETOCI. So your new reclassification is OCI. So the difference should be transferred to OCI. No, I'm moving from FETOCI to FETPL. So your new classification is FETPL. Then the difference between the carrying amount and fair value on the reclassification date is going to be transferred to PL. Okay, right. So right, FETOCI to amortized cost I am moving. Yes, if it is reclassified to amortized cost, any interest or whatever the calculation, it obviously transferred to profit and loss. That's why that difference also should be transferred to PL. Anyhow, I'm going to present that part also here. Right. What can be reclassified? First question. Answer all of you. Suppose I have equity instruments. I have classified as FETPL. Okay. Yes, your answers. I mean, can I reclassify this? It is a financial asset. Obviously, it's not a financial liability. Can I reclassify? Is it allowed? Does it allow? Yeah, one answer I got no. No. Okay. Superb. No. It's not possible. Yes, all of you obviously. That's what you please answer whether right or wrong. That just forget about it. Right. Yes. Equity instruments not revocable option. Okay. Yes. equity instruments, obviously and automatically it will fit under the third business model, that is residuary model. It is supposed to be FVTPL, but it can be classified as FVTOCI under irrevocable option. Got it? So here I said it is FVTPL. So once it goes FVTPL, right? If you want to come to amortized cost FVTOCI, there should be some contractual cash flows. In case of equity shares, if you correct me, you don't have a period first. There is no contractual cash flows, so it cannot be reclassified. So that your answers are perfectly all right. You cannot reclassify. And if you want to transfer it to FET no, that should have happened at the initial recognition. That is irrevocable initial recognition. It cannot be taken place at later point of time. Okay, subsequently you cannot do that job. Right. Next question, all of you try. Equity instruments which were classified as FET. So can we transfer it to FETPL now? Can we transfer it to FETPL? Okay, one answer yes, no answers, two answers no, yes, yes, mixed answers. Oh, right. So the first thing, when you class equity instrument is always supposed to be FETPL, right? When it is gone to FETOCI means it is an irrevocable option. So irrevocable in the sense once it goes to FETOCI till its life end, that means till the time of disposal, it can never be reclassified. I hope you understand. That's why here also reclassification doesn't work. Right. So then what will you reclassify under a financial asset? The reclassification, the entire concept is applicable to a pure debt investment. A pure debt investment. Debt investment in the sense not even convertible debt. Okay, it is just a plain debt. Non-convertible debenture or loan, such kind of instrument only can be reclassified into another correct classification, right? But other than that, nothing will fit into this concept. That is the only one thing which is possible. Okay, let's get into the, I hope so far concept is clear, right? Shall we get into the measurement and accounting? Right? Yes. So measurement accounting, this is a very simple, as I said. See here, totally there are 6 possibilities. Correct. Amortized will be going to amortize. Obviously it will not go. Correct. Nothing to, there is no reclassification. Can amortized cost can be classified to reclassified to FETOCI? Yes, it will be. Correct. Na? And we are moving to new classification of FETOCI, OCA. The difference between the carrying amount, the fair market value on the date of reclassification, as I already told, it should go to OCI. Correct. Now tell me, all of you should try amortized cost to FETPL. Now, are you supposed to measure it at fair value? And the difference should go where? Difference should go where? Yes, please. Participation is important. Yes, obviously. If the new classification is FETPL, so the difference obviously will go to profit and loss statement. Perfect. And what about this? FETOCI to amortized cost is going. Yes, it is. I told you it's a plain debenture. Yes, it can go. Now the difference should go where? It will be measured on fair value, and the difference should go to yes, yes, please. Everybody try. Difference should be obviously reclassification effect should go to profit and loss. As I said, amortized cost impact always goes to profit and loss. Nothing will go to OCI. Right? FETOCI to FETOCI obviously cannot happen. Correct? Now FETOCI to FETPL. Now again, where should I transfer the difference? Yeah, the new classification is PL. Correct? Now FETPL, the difference also should be transferred to profit and loss statement. Perfect. Right. So that is the one. And the last one, FETPL was the old classification of mine. Now that is going to amortized cost. That's going to amortized cost. Right. Yes. What do we do here? See, when it is right, one question, which is which difference exactly? Which difference in the sense the fair market value on the date of reclassification and the book value, the carrying amount, the difference between these two. Okay, that difference should go where? That is what we discussed. Right, FETPL to amortized cost. Yes, it is like if it is a debt instrument, as I told you, this entire reclassification is applicable to a debt instrument, obviously not for an equity instrument. Yeah. So if it is FETPL, debt is classified as FETPL. It's right. If it is classified as FETPL, the interest element, you don't need to follow strictly amortized rule. Whenever the interest comes, then it is supposed to be transferred to profit and loss. But FETPL earlier classified, now I am moving to amortized cost. So when it goes to amortized cost, obviously year calculation and all applicable. So now what should I do? Nothing, as usual, simple. Fair value, yes, on the date of reclassification you measure it. The difference between, obviously it's already fair value, but okay, see, 31st March 2025 you did the valuation at fair value. Okay, say example 100 rupees. Subsequently, your reclassification need not happen on 31st March. On 30th 6, you are reclassifying. Okay, that day fair market value is 125. So the 25 will be transferred to profit and loss. Now your value carrying amount has become the fair value, which is 125. This 125 is going to be your new carrying amount, and that amount is supposed to be utilized, used for the calculation of EIR. Okay, that effective rate of interest or effective interest rate. So now afresh you are supposed to calculate. So as if old instrument of FETPL is sold in the market, and today I bought a new instrument and I'm classifying it as amortized cost. Okay, my cost is equal to 125. What are my future cash flows from today onwards? Yes, that then you are supposed to calculate your EIR, and that should be followed in the future. Right. At the same time, FETPL was the old classification. Now it's going to FETOCI. Okay. Here also, right. Again, you will fair value. The difference between book value and this is going to be transferred to OCI. Here also same thing. Even if the debt instrument, even if it is classified as FETOCI, interest element, the finance cost is supposed to be applying the EIR method only, because it's a debt instrument. Except FETPL case, under amortized cost and FETOCI cost, you should and must calculate the EIR. That's why the new fair value which you have recognized, that will be the carrying amount, and based on that you are supposed to calculate EIR. And again, one more important point which I have written down: the minute you are transferred to the new classification, when it is going to be amortized cost or FETOCI, immediately something should strike. No, now impairment rules will start. Yeah, when it is FETPL, right, that is not applicable. If it is FETOCI, a debt instrument, also impairment rules are going to be applicable. Impairment is obviously going to be taken as a third topic today. Okay, if the, right, one second. Yeah, if the investment in equity is more than 50%, how should I consider? See, when the equity is more than 50%, it is not a financial, it is a financial instrument, but is scoped out of IFRS 9. It is considered as like your IAS 27 will be handling that. Okay, so this, whatever this explanation, nothing is applicable to you. Right. So next, so in case of FETOCI, FETPL, there are already fair value in the books. So then where will be the difference? As I told you, Ash, it is not exactly. So you will not do fair value on every day. So reclassification not necessarily supposed to happen on 31st March. It can take place during the year. That's why from the last reclassification to the day, last fair valuation to today's reclassification, there can be any plus or minus that is supposed to be accounted for. I hope that answers. Okay, right. Any questions further on this? That's all. This is a very small topic. We'll get into the one more beautiful and important topic, that is derecognition of financial liabilities. Okay, derecognition, right? The sentence itself says very clearly, your recognizing is taking into books of account, derecognizing is removing from the books of account. Perfect. So what is, first I'm taking the financial liability derecognition, then I'll go to derecognition of financial asset. Yeah. So derecognition of financial liability. Okay. When do you derecognize? When do you take it out of the books? Okay. When do you do it? When my financial liability is extinguished. I am no more liable to anybody. Then you please take out of your books of account. Okay. That is, when do I say I am no more liable? I have already discharged my obligations. Yes, I paid the principal, interest, and whatever it is. Correct. Or it got cancelled, or it may be waived off the other party, or it expired, whatever the reason. When you say as on today, 31st March, or whatever the day, I am not liable to anybody, your liability is extinguished. Yes, please remove it from the books of account. Okay. So what is the criteria? As I said, you did the job, you made the payment. Yes. Are you supposed to provide the goods or services to some other party? Whatever it is as per the agreement, how did you settle? You can settle it by giving the cash, or if it is the other way around, any another financial asset or something, yes, your job is done. Or legal release, that may be a waiver or that may be cancellation from the obligation. Yes, that time also we are supposed to take out from the books of account. Okay, our we had an obligation, that obligation is expired. That is also one more thing, right? You should not de-recognize it when. Okay, right. We should not de-recognize it when that is one circumstance I can tell, only when the terms are modified. Again, modification, it should not be a substantial modification. What is substantial, what is non-substantial, that we are going to cover it. We'll say the substantial is like more than 10%, the modification, terms modification, restructuring of the loan or anything can take place. The impact of the restructuring, if it is more than 10%, then it will be considered as substantial modification. Okay, in case of substantial modification, you need to de-recognize the old liability and recognize the new liability. Okay, sir, suppose example, my impact is not 10%, is below 10%. Then do not de-recognize the old liability, continue the old liability, but there will be a plus or minus to it, that should be transferred to profit and loss. Okay, right. Take up another financial liability is the same example. I think that covers my point. Anyhow, I have taken few examples, that is refinancing, restructuring. I'm going to cover those situations now. So I have given some 5 to 6 scenarios. Okay, first one is very simple scenario which everybody will answer. Just waiting for that. Company Alpha repays $5 lakh bank loan in full. Okay, on the date of maturity. What should I do? Shall I de-recognize? Shall I continue? What do you suggest? Superb. De-recognize it. Yes, we are done with our job. Correct. Very simple example to start with. Liability is extinguished. Yes, we already made the payment. I'm no more liable to anybody. Correct, na? Right. De-recognize the liability. Suppose you're not liable if you had paid 5 lakh out of 5 lakh fine. Suppose it was 5 lakh 25,000, but you paid 5 lakh 25. I mean $5 lakh only you cleared it. If there is any small difference, that's supposed to be transferred to profit and loss statement. I think this is very simple and clear. Let's take the second scenario. Okay, bank waives $1 lakh of company, be it as 4 lakh loan. Okay, right, on whatever it is due to restructuring. So there is a waiver basically. Right, what should I do now in this case? Yeah, partial de-recognition. Perfect. What about others? Yeah, it's a waiver to the extent of $1 lakh they waived off. So that isn't it a gain to me? Obviously an income. Correct now. Reduction of a liability is an income to me. So yes, that's why what are we supposed to do? Yes, obviously, as you said, right, it is de-recognized waiver. It is not the terms and conditions changed. Terms and conditions were same. Only waiver is taking place. I will not consider it as a significant modification or something. Waiver is something different. Okay. So de-recognize the waived portion and recognize because terms and conditions, all other terms and conditions are remaining same. That's why I don't want to take it as a modification to the agreement. So recognize the gain in the profit and loss statement. Okay, right. This is something new, a different and small scenario which I saw recently. Can you please? I'll read out for you. At the same time, you please suggest what can be the better way. See, the company has, they have NCDs. Okay, it is some NBFC company. They have issued some NCDs to some people. As per the agreement, every installment amount, which is interest, principal, everything put together, will be transferred to escrow account. Right. Afterwards, the company will release one letter to the banker. Banker will transfer that money to the bond holder. Okay, NCD holder basically. Right. They have transferred the money on 31st March. Okay. But from the escrow account to the lender account, it has gone on April 2nd. Right. Should I de-recognize it on 31st March or not? Right. When should I de-recognize it? What's your answer in this? April 2nd, 31st March. No, don't. Okay. Yes. No. Derecognize on April 2nd, 31st March. Okay. Yeah. See here, the point is, yeah, I mean, everything, all of your answers may be correct, but it is actually subject to the terms and conditions which are there with the escrow account. Okay, right. The question is, once I transferred it to, correct, once I transferred, you have to analyze it, you have to understand the escrow agreement terminology also. Correct. After just immediately after transferring to escrow account, whether my liability is extinguished to that extent. Correct. Do I have any legal control over the money? Right. Legal control in the sense like from that money, can I transfer it to somebody else? Can I withdraw back? Correct. Do I have that power? That one has to assess. If you say I have the power to take it back, okay, then it is not extinguishment of liability. Still money is under my control. Then please show it as a cash and cash equivalent. Okay, right. See, it always depends on escrow also under whose control it is. There are some terms and conditions are there. Okay, right. That's why. So first one need to read the escrow arrangements. Right, arrangements is very, very, very important. The payment is once you transfer it to escrow, I cannot take back. Irrevocable. Then your obligation is done. Correct. Now, then you can go ahead with the derecognition on 31st March itself. If you say still I have a control, yes, then yeah. If I have a control over that, then please do not derecognize. So the answer cannot be so straight, right? But generally, once you transfer, like what someone was telling, once you transfer it to money to escrow account, you cannot be able to recall it. I agree. That is most of the circumstances. What you told is perfectly all right, right? So that's why I said if in the most of the scenarios we'll consider it as a repayment. As both our answers are fine. Practical approach can be most of the circumstances. We'll take it as April 2nd only, even though you cannot call it back. Okay. All right. One more scenario. Just have a look at this information. So it's a substantial modification. 10% test is passed. How 10% test is passed? Let's see this. Company modifies $8 lakh loan. Okay. And it pays 40,000 fees for the restructure. Yes, you are supposed to make a payment if it is a banker and etc. It's generally it happens. So the present value of the modified cash flows, including the payment and etc., discounted at the original EIR. Okay, right? Modified cash flows as per the new arrangement. What all the cash flows you are supposed to pay over the remaining period? Right? Using the old EIR, it is coming to 7,10,000. Okay, done. And what about the present value of the original cash flows? That's 8 lakh. If I have not made any change, it would have been 8 lakh only in normal. Correct. So what is the difference? So difference is 90,000. 90,000 divided by 8 lakh. That is obviously 11.25 percentage, which is crossing my 10 percentage. So there is a substantial modification is taking place. As I said, if there is a substantial modification, you are supposed to derecognize the old liability, recognize the new liability, right? And as usual, the difference between these two numbers will be transferred to a profit and loss statement. Okay, so it's a substantial modification. Derecognize the old one and recognize the new one. Yes, if there is any gain or loss in this, obviously there will be a gain or loss. So in this case, that will be transferred to profit and loss, right? Fees paid. Yeah, it's a very simple journal entry also I have provided for your quick understanding. Your old loan account was 8 lakh. So that is debited. So that old account is closed. New loan present value, yes, considering the new terms and conditions and etc. It's going to be 7,10,000. Yes, considering the modified cash flows, right? And the gain due to this is 90,000. That is what considered. Why old EIR and not the modified EIR for the substantial modification? See, when I want to compare two numbers, when I cannot apply for one old EIR and for the new one new IR, then it is not comparable for the percentage purpose. So to test this 10% or above 10%, to test with above a 10%, for both the situations, you have to apply old EIR. That's why it was very clearly guidance is provided in IFRS 9. Okay, right. So shall we go to the next situation? Right. Next situation, a non-substantial modification, which is less than 10% right, impact. So here, the carrying amount of loan is $6 lakh. Fine. Present value of the modified cash flows is going to be is 5 lakh 50, and but present value of the original cash flows is 5 lakh 60,000. So the impact is hardly 10,000, which is 10,000 out of 6 lakh. What it's like, it will come to 1.8 percentage. It's below 10 percentage. So it is not a substantial modification. Then what should I do now? What should I do now? Yes, as I said already, we do not de-recognize the old one. Old loan will continue, but yes, I have to bring it to the present value of the new loan. Right, exactly. The difference amount, the difference of 10,000 is going to be, right, it's going to become, it will be transferred to profit and loss statement. Right, it was 6 lakh, correct. Now, new loan is equal to 560. So 40,000 is going to be adjusted with, right? That will be transferred to profit and loss. Yeah, your loan 6 lakh, I mean, I say old loan debit 40,000 to profit and loss. Yes, it's going to be 40,000. Like that, it's directly, it will be reduced from the old loan to old loan, that's all. And the difference amount will be transferred to profit and loss statement. Right. Shall we go to one more scenario? Right. Very simple. Company Jetta changes the loan currency from INR to USD. Okay, loan currency is changed. Yeah. So, okay, once again, Yash is asking one more question, like then compute the income at the new IR also? No. In case of when there is no de-recognition of the old loan, no new EIR will come. That's going to be only old EIR will continue. Okay, right. Chalo. Let's go to the this point. Right. In this case, what is going to happen? The factoring, we'll see that in the maybe next financial asset situation, I'll take it up. Right. Companies, Jetta changes loan currency from INR to USD, even though the 10% test is not met. Right. What do you do now? The currency of the loan is changed. Right. Shall I consider it as substantive modification or non-substantive? Any answers? Try. Right. Even though amount wise it is not substantive, as I said, 10% test is not met, but when the currency, that's obviously a qualitative modification. It's a qualitative modification. It's obviously significant. Yes, you have to treat it as irrespective of 10% test. This is treated as substantive modification. As people rightly said, it is de-recognize the old one and recognize the new one. That answer will continue. Right. Let's go to the scenario 7 of de-recognition of liability. Right. This generally people must have seen in their respective companies also. Parent company gave some loan to a subsidiary, correct? After some period, parent company forgives. Okay, 10 lakh, I mean 1 million I gave it, 3 lakh I have forgiven. You don't need to pay. I'm not expecting any, I'm not going to recover this amount. Then what should I do with this 3 lakh? How are you supposed to account for? Yes, please. De-recognize 3 lakh, correct. But where do you transfer this 3 lakh amount? Shall I transfer it to P&L? So it's going to be investment in subsidiary. Okay, that is from the holder, I mean, parent company books. What about from the subsidiary books? It's a liability. We are talking from the liability angle. Okay, yeah, it's a capital contribution transferred to retained earnings. Okay, so retained earnings, you mean to say, will it be transferred in the statement of changes in equity, or it will be routed through profit and loss statement? Below the line adjustment. Okay, superb. Right. Yeah. See, it is right? Options are there, but at the same time, right, it is an equity transaction, as people have rightly told, right? So first, loans are financial assets for one party, financial liability another party, which is amortized cost in general. Yes. Forgiveness is nothing but extinguishment of financial liability to the extent of 3 lakhs. So I have to de-recognize financial liability. No doubt about it. Correct. Okay, done. Correct. Now, what does the borrower do? De-recognize the, forgiven amount. Correct. Lender also will de-recognize the whatever given amount. Right. Borrower, it can be shown as an income, but most preferably it is not an income. It should be adjusted to equity. Get, as someone correctly pointed or correctly told, exactly, it should be transferred to retained earnings. There is an equity contribution indirectly. It should be as part of SOCIE, statement of changes in equity, not through profit and loss. That may be more appropriate. And from the parent, it is an investment. Correct now? Yes, it is either he can hit, correct now. If the other party is taking it to profit and loss, I also can take it to profit and loss as an impairment loss. Otherwise, it will be presented as an investment in the subsidiary. Yes, it is in there. It's a investment in subsidiary. Parent will be recognizing. The other party, subsidiary, should be recognizing as a contribution, capital contribution, that should be not routed through profit and loss statement. Right. I think this is clear. Can we go ahead? Shall we? Right. Chalo. Let's go to the de-recognition of financial assets. Right. De-recognition of financial asset is one more beautiful thing. Practically different kinds of situations and scenarios can take place. Okay. Let's try to answer one question that Mr. Kannan is asking. Company has a financial liability to company B with 30 days payment terms. Okay. But company A has financing the arrangement with company C. Okay. So the company A transferred its liability to company C with extended 30 days payment terms. Okay. Company C will pay to company B on 30th day, and the company A will pay to company C on 60th day. In this case, extinguishment of financial liability is required. I think I need to read once again. Right. Right. I think this is to everyone. Yes. A and B has a financial liability, okay, with 30 days payment terms. But company A has financed arrangement. Okay, they got it from company C. So the company A transferred its liability to company C with extended term. Correct. Company B to C, financial liability. Yes. No. What I am reading it from the message, basically. That's why slides are not going. Yeah. So here, see, the point is you have got two agreements. Correct. Now, one agreement you have taken the money from one party and you have given the money to another party. Correct. Now, so you cannot interlink it. You treat it individually. So first, right, when I make a payment to this party, then my financial liability is over with respect to de-recognition of financial liability. You have to treat, these are the two different agreements with two different parties. Yes, you must have got the finance from C and you are giving a finance to B. Correct. These two, one is a financial asset, another one is a financial liability, right? So it will be presented separately under financial asset and financial liability. De-recognition also will happen separately to that. Okay. Right, I think that will answer. Right. Chalo, let's get into the financial de-recognition of financial asset. Right. When do you de-recognize the financial asset? Yeah, here, practically when you, terms and conditions are very crucial. Maybe a trading company, a manufacturing company, a pharma company, maybe may not be having such kind of difficulties, but if a financial institutions, correct, when they sell it to one, they create some ARC, asset restructuring company, correct. And they will try to shift their NPAs to the other company. Correct. Then you are supposed to be very careful. Correct. Now, what are the terms and conditions? Is there a recourse or without recourse? Correct. Now, are we giving a financial guarantee to the ARC or any kind of guarantee are you going to give? Right. Those terms and conditions will change the entire accounting. Okay. Sometimes, like even though we transfer a portfolio of loan to another company, I do not de-recognize my financial asset from my books of account. Okay, right. So it depends. It depends upon the terms and conditions. One need to read, understand the terms and conditions very, very clearly. Right. So I'll give you overall idea. At the same time, I'll take you to some 2, 3 scenarios I have prepared for you. Right. Let's try to listen to that. Okay. So de-recognition of financial asset. See, when do I de-recognize it? When I don't have any control over the financial asset. What do you mean by control? Control over the cash flows, right? I'm not correct. I don't get any money, right? No, you'll only get the money, right? Okay, I'll get the money, but the minute I receive the money, immediately I have an obligation to give it to a third party. Okay, then what do you call this? I call this as a servicing alone, right? What are you? I'm just a middleman. I just receive the money from some party. I'll give it to another party. Okay, suppose I have a debenture. Assume I cannot, just imaginary situation, right? I will not be able to transfer it to another party, but I will sell it. But I will tell the other party whatever the money comes from the company. Suppose I'm the holder of the debenture. I'm talking about financial asset, investment in debenture. Okay, so when the money comes, interest comes to me. They will transfer it to me. Right, immediately I'll transfer it to other party. Correct. So here I am receiving, but it is not my money. I have an obligation to transfer it to another party. So since I don't have any control over the cash flows, I'm just an agent to the other party, right? It amounts, you are supposed to de-recognize such financial asset. That's why, as I said, the terms and conditions in financial instruments are obviously very, very, very crucial. One need to read it again and again till we understand and what are the crux in the terms and conditions. Okay, so expiry of contractual right to the cash flows, if you are lost, yes, please, then de-recognize it. Right. So you transfer the asset with the assessment of risks, rewards, and controls. Everything should be transferred to other party. I should not have any basic involvement. Maybe very basic involvement is fine. You should not continue to have an involvement in that asset. If you have anything, then as I said, okay, you are not supposed to de-recognize it. So if I don't de-recognize, then what will happen? Your asset will continue in the books. In addition to that, whatever the money you have collected will be recognized as a financial liability. I'm going to explain with one scenario I have made it for you. Okay, say example, sale with substantial risks and rewards which are retained by the company. How does it happen? It will happen, right? I told you, like, scenarios are there, number of practical situations are there for these cases. What are we supposed to do in this case? Like example, right? Receivables are sold, yeah, factoring with a full credit guarantee. Yeah, I say I sold it, right? It's like simple example, discounting a BR, isn't it? Discounting a BR. When I say bills receivable is discounted for, right? To the banker has discounted. If some person has not paid, then end of the day I am liable to pay, isn't it? I'm liable to pay. Correct. Now banker will not bear 1 rupee also, one rupee or $1 ka loss. So then, right, when I discount BR, what is the journal entry we should recognize? What should I do? Can I expect some answers? When there is a discount of BR, what should I record? I received money, cash debit or bank debit. What should be credited? BR is my financial asset. So shall I credit BR? Yes, cash or bank debit. Credit what? Okay. Loan account debit to bank. No. I think bank to BR. Yeah, it is obviously with recourse. Whenever we discount a BR, correct now, bills discounting, when there is a default by the other party, correct now, default by the other party, bank will give back. It is obviously correct now, assumed. That's why when the money has come, I discounted, money has come. So whatever the bank account debit, yes, to It is not going to be FA, that is a BR, it is going to be a financial liability. That is what you are supposed to do here also. Because even though I have given the BR to other party, all the significant risks and rewards are still retained by my company or by me. That's why I'm not supposed to de-recognize the financial asset. So instead, what are we supposed to do? To the extent of money you got it, then yes, bank account debit to a financial liability is supposed to be created. As rightly said, it is not a bills payable, but it is a liability. Financial liability is supposed to be created. Okay, right. So that is how it happens basically. So that's what important, right? There is one more word here in this standard: continuing involvement. Okay, when do you say that we have a continuing involvement, right? Few little more information I just would like to share here, right? It arises when the entity transfers some financial asset, but we retain some contractual rights or obligations related to that asset. So still, that means 100% I have not sold. Still, I have got some involvement with this. Okay, what are those examples also we'll see, right? Entity does not, under that circumstance, you are not supposed to fully de-recognize it. Okay, that means partially can I de-recognize? Yes, you can do partial de-recognition, but keep the financial asset to the extent of a continuing involvement. Okay, how does it happen? I think the example will make it much better, right? I have an example in the next slide, right? This happens, correct now. So some common examples: retaining a subordinate interest. What is subordinate interest? Subordinate interest in the sense, say example, I have 1 million, 1 million, one bond is there. Okay, I sold it to you. Suppose say 8 lakh worth of bond I sold it to you. Right, 2 lakh only I kept it, but with subordinate interest. What is subordinate interest? I say up to 80%. I mean, correct. Your interest is supposed to be say 10%. 8 lakh into 10% is equal to 80,000. So 80,000 should be given to you first. Suppose actually the other party, the issuer of the bond, should give me 1 million into 10% is equal to 1 lakh. 1 lakh should come to me, then I should give you 80%. This means 80,000. Correct. But suppose due to some circumstances, the other party has given only 90,000. Under 90,000 situation also, I have to give you full 80,000 to you, the balance 10,000. That means the loss should be borne by me. Loss will not be borne by you, right? Okay, if they give only 75,000, then only it will come to 75,000 to you and entirely. It is not on a proportionate basis. Interest is not going to be allocated between 80:20 ratio. Okay, so right, if it is allocated in 80:20 ratio, yes, please, that is you sold 80% is perfectly, then de-recognize to the extent of 80% here, right? So this is subordinate interest. What you get is subordinate interest, or retaining a servicing rights and obligations. Yeah, servicing rights and obligation in the sense you are behaving like a agent, right? Right, you will receive from the issuer, and the money is going to be given to the to whom you sold it, right? So since you will be receiving and you will be giving, and here rights, you are supposed to again read it very carefully. Sometime what happens, we'll be keeping some percentage, because I am doing this servicing a loan, I may keep some percentage of commission or such kind of thing. Then also it is 100% you have not transferred it. You need to recognize the financial asset to that extent exactly, right? Or you are holding an option to repurchase the asset what you sold. That means you have not 100% control is not given to other party. Yes, I have a call option. I can call back. I can buy it the anytime at given time. Okay, providing a guarantee on the transferred asset. Yes, I sold a portfolio of trade receivables or portfolio of loan asset. Correct. In case if he finds any ECL, or if he's not getting the money, bad debts or something has happened, then to that extent I am only supposed to bear it. That means when are you say, how are you saying that you have lost the control or you have lost the significant risks and rewards of the asset? Obviously you have not lost. Still you have got involvement in the financial asset. That's why you are not supposed to de-recognize the financial asset fully. You are supposed to keep it to the extent of continuing involvement. Okay, yes. Let's look at the scenario 1, and there were some. Yeah, 2 questions are there in the chat box. Right. Companies discount their own invoices. Are we supposed to recognize AR as it is original value or value at which it will be liquidated? Okay. 1 second. Google here is what we do not have any exact date when the company will discount the invoice. Now, I didn't get exactly the situation. Okay. I'm sorry if you can elaborate, that will be great. Right. And one more question, if it is without recourse-full, hope that you can de-recognize. Yes. Yes, you can de-recognize the asset. If it is with recourse-full, we should not de-recognize it. We should recognize the financial liability. Yes, perfectly all right. That is correct way. Right. Chalo, let's come to the situation. Okay, scenario, and come back to the questions later point of time. Right. Scenario 1, right? What does it say? A partial transfer, and you are supposed to assess the control. Yeah, see the situation. A bank is selling 80% of cash flows from $1 million loan portfolio. Okay, right. Loan portfolio, out of that, 80% of the cash flows of this one, I am selling it to another party. Excellent. Retaining the 20% as a subordinate interest. Again, correct. Subordinate interest, as I said, you are absorbing the first loss. Right. So if the other party, I mean, to whom we gave the loan, that guy does not pay money, right? First, I will take the loss to the extent I can absorb. The 20% first loss will be absorbed. If the loss is more than 20%, that has to be borne by the other party. Okay, then that's very clear. The fair value of 80% sold, okay, on the date of sale is equal to $8,20,000. Done. And the fair value of what you have retained. Yeah, anytime fair value, if you want to calculate, you have to apply the today's market rate and the future cash flows you are supposed to take it, apply the today's market rate and discount the cash flows. That's how you will be able to determine the fair value. Right. Fair value of the 20% which you retained is 1,50,000. Okay, done. So carrying amount of the total loan, yes, in the books, it is 10 lakh. Now, this is the circumstance. So how should we account? What should we do? Recognition or de-recognition? Correct. Now, let us discuss. The first thing, bank has not transferred 100% of substantial risk and rewards because it is retaining subordinate interest of 20%, which we discussed already. There is a continuing involvement. Right. Subordinate interest, continuing involvement, the best example. Right. So what are we supposed to do? To the extent of 80% only, if it has lost the control over that portion, correct? Otherwise, it recognizes the entire asset to the extent it is of its involvement. Okay, right. Now, if you see the allocation of carrying amount, assume 80% is transferred to other party. Okay, let's take that partial transfer example. Okay, in this case, assume here, now for my accounting, what I am giving to explanation, okay, it is 80% transfer happened. Correctly speaking, when there is a if there is a continuing involvement to the extent of, if it is, a second line, we can read it once again, you can catch my point. The bank de-recognizes 80% only if it has lost the control over the portion. Okay. Otherwise, it recognizes the entire asset. Entire $1 million is supposed to be in the books of account to the extent of its involvement. Assume I have not transferred. Okay. My below information, what I am giving, I am taking a opposite information, like saying that I have lost control. How do I account it? Okay. Right. When I say I lost control only to the extent of 80%, fine. Right. So how do I account for? So that first total fair value of the bond today, 8,20,000 of what you sold, what you retained is equal to 20%, which is 1,50,000. Total it is equal to 9,70,000. Okay. And the portion you are de-recognizing. Yes. As we concluded for my accounting, I am saying 80% control is gone. So when I say 80% is, my carrying amount is 10 lakh. 10 lakh divided by 9,70,000, that is the fair value. And with in the ratio of the fair value, the total fair value is 970. Out of that, 820 is gone. So my carrying amount, which I should remove it out of 10 lakh, 10 lakh, 8 lakh 45,000, 8 lakh 45,361 should be removed, right? It means 8 lakh 45,361 carrying amount of financial asset has been sold for 8 lakh 20,000. That means that 25,361 is nothing but a loss. Correct. Na? You sold your asset of 8 lakh 45,000 carrying amount of asset sold for 8 lakh $20,000. Correct. Na? So the difference is a loss. You got a lesser amount. So 25,361 should be transferred to profit and loss. Right. So the carrying amount, how much I should retain? I'm removing 845. So 10 lakh minus 845 comes to 154,639 should continue to be a financial asset considering the assumption. Okay, right. So there's a loss. I mean, the total gain or loss is going to be 8,20,000. Money has come. 1,55,50,000 of the new value of the asset has come. Correct. Now 8,45,000 I should de-recognize it. Right. So 1,24,169 is going to be the your gain or loss. From straight away, I mean, there are the gain or loss from the two things. 1,50,000 is the asset. I mean, if you see net effect is equal to 124,639 is going to be your gain or loss here. I mean, gain basically. Yeah. Can I go ahead? Right. This is one more scenario. Yeah. Here we are in this scenario. This is like practical scenario which happens in NBFCs and these financial institutions. Yeah. Let's read the scenario carefully. You will understand it while reading itself. What is supposed to be done? You please answer accordingly. Shall we de-recognize it or should not de-recognize it? Right. See, suppose an NBFC sells a loan portfolio with a carrying amount of 50 CR. Okay. Right. To an asset reconstruction company, ARC, simple short form. Okay. So here, this we are going to get 40 CR upfront cash from the ARC. Okay. The other company which is born to take over such kind of NPA loans and etc. They are purchasing the 50 crore worth of carrying amount worth of loan book for 40 CR. Done. The NBFC retains a subordinated interest, first 10 crores in the portfolio, which absorbs the first loss, which I already explained. The NBFC also provides credit enhancement. Okay, pledging the fixed deposits worth of 5 crore rupees to the ARC to cover the expected credit losses. So in case of any credit loss is there, I mean credit loss in the sense it's a bad debt or something. Okay, right. That to the extent of 5 crore, we are pledging the fixed deposit in the sense, obviously, to the extent of 5 crore, if there is a loss, that they can withdraw the money. Okay, so we are giving a perfect financial guarantee to the other party. Right. Expected credit loss ECL of the portfolio is estimated only 4 crore, but fine, we give 5 crores of fixed deposits as pledged. Right. The NBFC continues to serve the loan portfolio. Yeah, you are serving in the sense you will get the money from the loan people. I mean, whoever the borrowers, that money will be given to ARC. Still, it is in the name of my company, NBFC. NBFC has not transferred substantially all the risks and rewards due to the subordinate retention and credit enhancement. Yes, obviously, the NBFC has transferred a contractual right to receive the cash flows but retains significant risks. Right. So while reading itself, what are we supposed to do? The 40 crore rupees, whatever we have received, 40 crore rupees, whatever we have received, should I recognize as a financial liability or should I de-recognize the financial asset and record the 10 crore as a gain or loss? Okay, one answer has come, de-recognize 5 CR and 5 crore, move it to fixed deposit. Okay, financial liability of 40 CR. Cool. Any answers? Recognize the financial liability. Yes, financial liability. Yeah. Here, subordinate, I mean, in the earlier example itself, subordinate interest, I said there is a continuing involvement you should not recognize. But in earlier example, I just wanted to explain the partial derecognition. That's why when we are calculating, we took an assumption control has been transferred. That just to explain the calculations. That's all. Right. But whenever there is a subordinate interest, there is obviously a continuous involvement. We should not derecognize the 50 CR. Whatever the amount you have received, that is supposed to be recognized as a financial liability, which you see in the step number 3. Recognize a financial liability of 40 CR. And whatever the pledged fixed as fixed deposit is in your name. It is pledged for something. Correct. Now, so it will be a fixed deposit in my NBFC books of account only. Right. We will say it is liened or it is given as a pledge to another party. That information we are going to disclose it. That much only we are going to do. So in my books, totally on the sale date, in the sense when I get the money of 40 CR, right, we'll say bank debit and financial liability 40, and the loan book of 50 crore will continue to be in my books of account. This is in the books of NBFC I am talking. Okay, whatever the pledge, correct now. Yes, this is my bank, correct now. I have made a fixed deposit. So fixed deposit account debit, credit is going to be given to bank. It will be my fixed deposit as a disclosure of pledging, correct now, or lien, whatever you call, that information is going to be provided in the books of account. Okay, right. To this extent, I mean, overall idea. See, here practically number of scenarios, number of transactions will be taking place with respect to financial asset, financial liability. Okay, retaining ECL on books implies credit loss is retained. Yes, obviously you have given indirectly a guarantee to the other party. Correct. No? Yes, Rahul. You have given a credit. You have given a credit guarantee. So I sold it to somebody. When can you say I sold it to you? I can say that anything, whatever happens with respect to that loan book, that is your responsibility. Correct. Now, then only I can say I sold it. I don't have any significant risks and rewards. But I sold it to you. If somebody does not pay it to you, then I will bear the expenditure. Under that circumstance, how can I say I sold it? So that's why I'm not supposed to de-recognize it. Only whatever the amount received, that is continued as a financial liability. Okay, right. Chalo, let's get into the impairment of financial assets. Right. This is something, it looks interesting. Obviously, it's a very interesting topic. I have made one small, I mean, basic from the trade receivable angle. I just made one Excel also. Let me present that also little after explanation of overall idea about ECL. Okay, right. Uh, okay. Holding company, yeah, one question. Right, holding company provides a letter of comfort to the lender based on which lender finances a subsidiary. Any FL is supposed to be recognized in the holding company. This is a financial guarantee contract. FGC. Holding company. No, it's not a contingent liability, Mr. Shamu. It is a FGC. Financial guarantee contract. Yeah, in your example, subsidiary has taken some loan. Okay, for which a comfort letter is provided by the parent company to the lender. Right, I hope I am correct. Right, now it's not a contingent liability to be disclosed like earlier standards of accounting standards or something. No, as per IFRS 9, very clear, a financial liability. Yes, the present value of this is supposed to be considered. Okay, present value, how do you calculate again? Present value, some 2-3 ways you can calculate. How do you calculate present value? Okay, without comfort letter, what rate the lender would have charged my subsidiary? With this comfort letter, yes, that is comfort letter is nothing but a guarantee, right? They must have charged at a lower rate. So there is, say, example, 0.5 percentage difference. So the entire 0.5 percentage cash flows will be brought into present value. To that extent, you should recognize as your liability, right? Since you gave a comfort to a subsidiary, that amount will sit as an investment in subsidiary to a financial liability will be recognized. Okay, not only this method, there are another 2-3 methods, or 2-3 methods in the sense, suppose if I go and ask for a guarantee to a banker, right? Generally, banker charges somewhere like 0.75 to 1% as a fees, correct? Now, like that also you can take it. That so investment again, entry will remain same, amount will change because on the fair value, how do you measure it? Okay, so fair, I mean, again, investment in subsidiary, debit to a financial liability to that extent amount of if I am a banker, what I would have charged, right? Then that I am losing now. That what I am losing is for the purpose of my subsidiary. That amount will be investment in subsidiary. Hope I answered. Okay, right. Impairment of financial asset, as I was, yes, starting this, a beautiful topic and a complicated topic. Again, it is very complicated when it comes to a financial institution. NBFC or a bank or any such kind of financial institution, the calculation is not so easy, right? You have to consider so many factors, macroeconomic factors. Yes, the so many industry factors. Correct now. Macroeconomic factors like what is your GDP, correct now, and what is the inflation, industry impact, right? So many things are supposed to be taken into account, right? Right. Chalo. Let's see the how does it happen. I would like to explain overallly how does it happen, and 1 or 2 examples I'm taking it. And the given time, in the given time, it is, I mean to say, explaining for what is applicable to NBFC, right? It is just impossible. It'll take like 4-5 hours of time to make you understand, and subject that understanding also, can I guarantee, means it's very difficult to guarantee, because you should have, because we'll apply like standard deviation, Z factors, correct, na, correlations, and so many things, correct, na, so many things is going to be applied, right? That's why it is not that easy to make other party to understand. But anyhow, I am taking a simple example and overall idea can be conveyed. Okay, right. So ECL methodologies and models, correct. Now, there is no specific method or a model prescribed by IFRS 9. First point, I would like to tell that. And it is principle based. You see the situation, the company, nature of financial asset, correct. Now, accordingly, you can decide it. Yes, there is obviously some management judgment, right? Standard says that you don't need to invest, you don't need to pay huge money, and to just for calculation of ECL, you don't need to spend huge amount of money. Agreed. That is what said by the standard. You don't need to spend huge amount for this purpose. Okay, done. Now, next point, what is the point? Is say you don't need to do PhD also for this. Okay, and are obviously you don't need to be noble, correct? No, yeah, you don't need to get that level of knowledge also not required. Yeah, simple model that passes a common sense test is good enough. That's what said by the IFRS 9. You don't need to look at so much deep and right. But under some circumstances of financial institution, no, it is required considering the given circumstance. Recently, yes, we are the auditors of one NBFC. The loan book is huge, somewhere around 5,000 CR. Okay, and the number of the token size is from 500 rupees of small token size, where they'll give 500 rupees of loan to a student, unemployed person. Okay, some 500 to 25,000 is the maximum token, right? So there are how many number of loans are there? Almost 9 crore items are there. So here, how do you observe, correct, the behavior of the borrower? Correct, right? So how do you take into many things? Under that circumstance, so simple method will not work. It's obviously not possible. Correct. So because it's a huge loan book, one has to consider, understand the behavior and the collection, that is recovery. Correct. Now we must have said that it's a written off asset. Yes, or you must have said it's an NPA. Right. As per the norms of RBI or as per the your norms, you must have provided, but over and above this, I must have recovered also. Yes, correct. I'll apply my ways to recovery. This, yes, every NBFC, every banking company has their methods of recovery. They do recover. May not be 100%, but yes, to some extent they recover. You cannot say everything is lost just because my DPD days past due is more than 90 or more than 120 days. Okay, right. So let's see some circumstances, right? But one point, like, I mean, if it is a regulated entity like NBFC or banker or some such kind of thing, where consistency is something where the regulators are also very keen on that, right? Whatever the model you are following in the current year, yes, that should be continued. You should not keep on changing some model so that my ECL should come to lower and I wanted to book lesser amount of expenditure and show a good amount of profit. That is unfair practice, basically. Right. Model can be calibrated progressively. Yes, obviously. Right. See, there are so many models. A transaction matrix method is there. Markov chain model, that's what nothing but, right? And discounted cash flow method is one more model is there. ECL for projected loans. So many different models are there in the market. But what is the financial asset of your company? One needs to understand. Correct. What model will be suitable? That also you have to take a call. Accordingly, you should apply it. Right. Just because there are so many models available in all, everything you don't need to do it. Next. Next, an important point. Whether impairment is applicable to every financial asset? Obviously, no. Okay. Right. What are the scoped in? Yes, this is separate scope which is given under IFRS 9. These financial assets are supposed to be tested for impairment. Okay, which are those? A debt instrument which is measured at amortized cost, debt instrument which is measured at FET OCI, okay, a plain loan which you gave it to another party, a trade receivables, yes, okay, loan commitments, a financial guarantee contracts which are not measured at FETPL, okay, and lease receivables as per IFRS 16. As if you remember yesterday, as when I was giving the introduction, as per IFRS 16 lease liability, initial recognition will be done as per IFRS 16 leases. But subsequent, correct na, subsequent after, I mean, impairment is going to be tested under this standard IFRS 9. Okay, a contract asset, unbilled revenue, yes, nothing but, right, a trade receivable, you can say instead of trade receivable, a contract asset, the language, right, that also supposed to be tested for impairment. For what you don't need to do anything. If it is an equity instrument, I say don't need to do. Why? Equity instrument is obviously measured at either FETPL or FET-OCI. Equity instrument measured at FET-OCI or FETPL not doesn't need to do because you already bringing it at fair value and the difference is either booked in the P&L or in the OCI. It's measured at fair value, right? So there's nothing to be done actually speaking. Or any other financial instrument other than the equities, any other financial instrument, loan commitment, everything measured at FETPL. If it is already measured at FETPL, you already taken it, not required to do any impairment. Okay, right. Here, which approach for what kind of asset? Very plain and simply explained here in one small diagram. Right, general approach, simplified approach. There is actually standard speaks and says very clearly number of places in the standard, in the guidance. Don't need to complicate it too much. Unless, as I said, my company is a financial institution or bank or such kind of things. Otherwise, you don't need to complicate yourself. Okay, let's get into the directly what is ECL. Right, a present value of cash shortfall is nothing but my loss. It should be at present value, cash shortfall. Okay, what is present value of cash shortfall? Just example, my contractual cash flows, I'm supposed to receive 1,000. Okay, right, but out of that, considering the situation right now, maybe considering the position of the borrower or considering the position of my customer, I'm expecting a cash flow of only 800. Okay, then the cash shortfall is nothing but 200. Okay, that is nothing but a provision what you make, a provision for doubtful debts or allowance for doubtful debts, language is same. Okay, that $200 is going to be your ECL. Okay, how do I calculate this? Yeah, I can say there are three elements basically. One is EAD, exposure at default. Next is probability of default, PD. The next one is LGD, loss given default. Yeah, I'll explain each terminology. Okay, so first, what is exposure at default? If the default takes place, what is the exposure? I gave a loan to somebody 1,000, or my trade receivable is 1,000. If default occurs, 1,000 is gone. Correct. Maximum to the extent of 1,000, it can go. It can go. Maximum to the extent. So that is nothing but simple a carrying amount, I can say in simple words, or outstanding amount, I can say. When I keep my loan or loan book into my mind, correct, no? Then I should say principal plus interest is going to be considered as exposure at default. Done. That into, okay, probability of default. PD is my short form. Okay, what is probability? So what are the chances of happening this default? Likelihood of default. Okay, so this, how do you calculate what is the likelihood? Yeah, you have to consider many factors. Okay, yeah, you should consider the historical factors, and you should actually project. The projection, as I said, for a different, I mean, NBFC and such kind of things, so you think too much about it. Right. Historical, I wanted to consider, and I can say that my history only may continue. That assumption also you can take it. I told you, subject to which, is it for trade receivable or is it for what item? You have to be very careful in that judgment. There are many ways. As I told just now, discounted cash flow method, Markov, transition method, as a simple word, transition method I can follow. Many methods I can follow for this. Okay, again, that is going to be multiplied with loss given default. Okay, what's my loss exactly? What is the percentage? Loss given default in the sense, yes, I gave 1,000 loan to somebody, but I know with my history of recovery, I have collected already 40 to 50%. I have collected the money. I can collect it. So my history says 100% is not lost. Correct. 100% is not lost. So 40% recovery is there, means 60% is my loss. Okay. So that is going to be your loss given a default. That is simple words, I can say 1 minus recovery rate. I can recover 40%. That means 60% is gone. Right. So what is the probability to occur such kind of default, and what is the percentage amount you will be actually losing if such a default occurs? Then if you multiply these three elements, EAD into PD into LGD, we'll spend time on each item in different scenarios. Okay, that's going to be your ECL, right? So here ECL, again, there are like stage 1, stage 2, stage 3. Done. So what is stage 1 is what? Stage 1 is like generally will follow 12 months credit losses. Again, what is 12 months credit loss? What is lifetime loss? Well, lifetime credit loss. There are again two words are there. 12 months credit loss means, right, if the expected default occurs within the next 12 months, what is going to be my loss? Maybe the loan period is 3 years or 4 years. In the 12 months, if it happens, what is my expected loss? Right. So here, if the instrument, right, from the date of, suppose example, to make it very simple, I have given a loan. Okay. The other party's credit rating is say AAA. Right. When I gave the loan, it was AAA. But today on 31st March, it is not AAA, it may be AA. Right. So there is a change. Is it a significant change? Got it? Is it a significant change? That one needs to, just a second. Time. Yeah. Yeah. So I'm just checking. All right. One needs to understand if there is a no significant increase in the credit risk. Suppose example, AAA credit rating has become B or BB credit rating. Then there is a significant change, not a slight change. Under that circumstance, no, you are not under stage 1, you will go to stage 2. Okay, right. So with a low credit risk, if you have got, And when I gave the loan, it was double A or it was B only. It was credit rating is B or BB, whatever it is. On 31st March, on the balance sheet date, also BB only. Right. So then there is no movement. Fine. Still you are under stage one. Okay. If there is a significant change in the credit risk, then it is not stage one. You are supposed to go to stage two. When it comes to stage two, it is lifetime ECL you are supposed to look at. I mean, what is the probability to happen the default throughout the life of 3 years of loan? If it happens, what is the recovery? Everything supposed to be taken into account. Okay, right here, if you have the significant correct full lifetime expected credit losses, as I said, if there is a significant increase in the credit risk, please take it. Or I don't have an evidence of impairment 100%. I don't have evidence of impairment, but yes, there is a significant increase in the credit risk. You will fall under stage number 2, right? Same significant increase in the credit risk, still you will go to stage 3, but where it is confirmed, means other party has gone for the insolvency, bankruptcy, whatever it is, right? It is evident money will not come. It is pakka, it is NPA, pakka, it is a write-off asset. I have got evidence. When you have got evidence, here also lifetime ECL. But what is the difference between stage 2 to stage 3? Stage 2, the interest element, any interest income will be recognized on the gross amount. Okay, gross amount in the sense, my exposure at default is nothing but say 1 lakh loan. 1 lakh loan is there. Minus if the ECL is equal to, example, if the ECL is going to be say 20,000. So presentation is going to be 1 lakh minus 20,000, 80,000 will be presented. But interest is going to be calculated on 1 lakh. Got it? But if you are under stage 3, the interest element will be calculated on the net number, which is 80,000. Right? Under stage 2, stage 3, lifetime ECL is only going to be calculated, but the revenue recognition is going to be on the gross amount or on the net amount, that depending upon stage 2 or stage 3. Okay, right. Anyhow, maybe you must have understood to some extent, but not 100%. But with an example, it will be much more better. Right. Yeah, okay. Yes, we'll see that point in time TCL and TTC ECL. Okay, that I'll little explain, not too much. Okay, all right. Yeah, chalo. Let's go to the steps. I mean, I made a very simple steps. It's not like great steps. First and foremost thing, segmentation of customers is important. Suppose if you're looking from the trade receivable angle or if you're looking from the loan book angle for NBFC, correct. Now, what kind of customers do you have? Right. See, one NBFC gives, what do you say, unsecured loans to students. Okay, to unemployed people. They are not students, but they are unemployed. Or there may be one more category, say they are employed, sir. Okay, but employed may also two categories are there. Where what is the two category? Where the money, their salary is directly coming via bank to their bank accounts. Or second category, they are getting they are employed, but the employer is giving the cash, not a bank transfer. Yeah. So risks are different. So risk based, correct. Situation. That's why your segmentation of customer is very crucial, because the segmentation based the probability of default also is linked. Correct. If it is a student, right, there may be high risk. Probability may be little higher compared to an employee where the salary is getting credited to his bank account. Hope you understood. So that's why segmentation is important. Segmentation may, you are correct. Now, suppose you have got 500 customers, credit risk characteristics, I told, maybe geographical reason, important. That why geographical reason? Maybe the economic conditions of the geographical reason also, it will impact my probability of default. So the customer type, correct, na credit rating, yes, many things are supposed to be considered, right? I don't have everything is same for me. I don't care much about it. Then you just go by the buckets of receivable, like 1 to 30. I mean, DPD, current in the sense which is not at due. Okay, 1 to 30 means after due date Past 1 to 30 days happened, more than 31 to 60 days, 62, more than that 90 days or 120 days, and etc. should be taken into account. Okay, right. I'm taking one simple example to make you understand. Later, I'll take you through Excel. In the given time, I'll be able to finish it. Okay, right. This is one small example. All of you should focus on the matter what I'm referring. A simple method and readily available information. Okay, and this method you cannot apply it on every financial asset. Again, I told you, that for that your professional judgment is seriously required. One has to assess every aspect, then only you can get into the method selection also. This is the transition matrix method. Okay, this is the basic information which has come from CRISIL. CRISIL reports say we have taken it. Okay, it is not not cooked or prepared. It's coming from the CRISIL website. Okay, see here, I have to read it horizontally. Okay, how do I read horizontally this? How to read this table? Yeah, please focus. See, I'm reading the first row and the second, first column, I should say. That is where CRISIL AAA I'm reading. That means, okay, 1 year transition matrix. Okay, what do you mean by 98.51 percentage? What is 98.51 percentage? So, in the 1 year time, yes, because CRISIL rating, to they have given it for number of, thousands of companies they have given, they know the industry average information. So this is more, much more better than what if I do individually. Okay, that's why I'm taking this. Right. So as 98.51 percentage in the sense, 1 year before, if my rating is AAA, 98.51 percentage chances are there to be AAA. Okay. So to become AA, there are 1.49 percentage. You have to read horizontally, I said. Okay. Just repeat it once again. Okay. So those guys, those companies or those holders, whatever you call, who are under AA rating, for them becoming A is almost 0 percentage. To becoming worse and again BBB or BBB, C, D, correct? Na? Right. D, I say default directly. No discussion. Right. So this like this, I should read it. Now come to the second row where CRISIL AA. How do I read? So out of the 100% of AA loans, okay, 1 year before it was AA, 95.22 percentage of such people, those people are continued to be AA. There is no change in their credit rating. But 1.47 percentage people have improvised. They have come to the credit rating of AAA. But 2.89 become worsen. Correct, man. So the AA rating to it became A. And like default to 0 percentage, like this is what it is talking. I hope you understood how to read the table. Any question on the reading the table? Any question on reading the table? Clear. Done. So, chalo, let's take one small example. Okay, this is for the 1 year. Again, 2-year transition also same way you are supposed to read it. Okay, 2-year transition means same example. 2 years before, what was the rating? After the 2 years, what is the current year situation? Reading style is same, but obviously numbers will keep on changing. Correct, na? Because what was there in 2 years before and what is it? Obviously, numbers are not same. It slightly changes. Okay, perfect. This is 3 years matrix information also I have provided. I'll come back. Okay, based on the requirement, I'll be back. Now the question, one small case study, very basic case study, nothing much. Okay, right. You just need to go through the information provided so that when I'm explaining, you will catch it perfectly. Right. Here it's a project loan. Yes, we gave a loan. It is a financial asset to me. Okay, right. Other we gave a loan. So loan amount is equal to some 23 lakh. Perfect. Recovery rate in case of default, 25% I'll recover. Means 75% loss to me. Correct. Loss given at default, 1 minus RR is equal to 75%. Very crystal clear. Right. Date of acquisition. Okay, I took or I issued, you can tell it. I gave a loan to any project on 1/4/18. Okay, one simple one date. Maturity date, 31st March 22. Okay. Right. So how many years of loan it is? 19, 20, 21, 22. So 4 years of loan. Correct. So where are you right now? So we issued on 1/4/18. Today balance sheet date is 31st March 2019. Okay. Right. Case 1. When I gave the rating, it is AA. On the date of case 1, I am looking at what is the credit rating of so and so party. Correct, na? Right. So when I gave the loan to a party, okay, when I gave a loan, that was AA rating. Today, on the date of valuation, it has become B. See, B means is there a significant increase in the credit risk or not? Answer me. Is there significant credit risk in the loan in the given situation? Yes, there is a significant credit risk. Right. Suppose now look at the case 2, the last column. Okay. In the last column, what does it says? When I gave a loan B, was the rating. Okay. Today also B. Today also B. Is there a significant increase in the credit risk? Obviously nothing. No, there is no big change. Agreed. Right. Exactly. What you said perfectly all right. So now the question. Now I have the real question. Now in case of case 1, shall I apply stage 1 or stage 2 or stage 3? In case of case 1, shall I apply stage 1 or stage 2 or stage 3? To the extent you remember, try please. Wow, many answers are stage 2. Very happy. Yes, all of you. Superb. Stage 2, not stage 1. Stage 1 nahi hota. It's not a low credit risk and there is a significant increase in the credit risk. So credit risk from where to where? From the date of initial recognition to the valuation date. AA was the rating to B. B is like almost out category. Correct, na? Yeah, B afterwards next to C and D only will come. That's all. Right. So that's why when in doubt, stick to the sender. Okay. All right. So it is supposed to be all right. Significant credit risk is there. Now, question. When you are under stage 2, next simple question. Answer all of you. Okay. Are we supposed to apply 12 months ECL or are we supposed to apply lifetime ECL? Lifetime ECL in the sense 4 years. 4 years means remaining is 3 years period. Lifetime or 12 months. Lifetime or 12 months. Perfect. You remember stage 2 situation. That's what I'm very happy. Correct. Now, are we supposed to calculate interest on the gross or are you supposed to calculate interest on the net? Gross or net? Gross or net? Yes, perfect. 1 and 2, when you have clarified, it's gross. Perfectly all right. Only in the situation, second, I mean, third stage, you are supposed to do it on net. Very happy. Okay, yeah. So, okay, someone is asking, suppose if it had been from AA to AA, I say it is not a significant change. That's my professional judgment. I say, obviously, there's one movement, it's a change, but not a significant change. Okay, that's judgmental. Okay, but that obviously there is no significant movement. Yes, it is a change. Every change need not be significant change. Now, let's go to the situation, case number 1, I am talking, where AA became B. Okay, perfect. So the original credit rating was AA. I just mentioned it here on the date of valuation. Correct. Now, the credit rating is B. Yes. So there is a significant risk change is there. So lifetime, I mean to say lifetime default is supposed to be applied. Correct. Now, lifetime should be applied. 1 year transition rate as provided in CRISIL based on the 10 years average is given below. Right. So are we supposed to apply 1 year ka 3 year ka transition matrix? 1 year matrix or 3 years matrix? Obviously 3 years matrix. This is just a small information. Correct na? This is not correct information. That's why you should not take this. Right na? Now we should go to 3 years matrix ko lena padega. Yes. Loan amount you remember 25 lakhs? 23 lakh. Yes. 23 lakh. Correct no? Am I right? I only forgot. 23 lakh. Yes, perfect. Come back. Okay. So 3 years matrix ko aa jao. Yes. I have come to 3 years matrix. Not 1 year matrix. Lifetime. So from valuation date, remaining number of years are 3 more years. Perfectly all right. Now, where are we exactly? We are under B rating. Correct. Now, what is B rating here? B rating is, can you see my cursor? I am saying like 58.44 percentage CRISIL B column. Correct. Now, CRISIL B column. Right. Under CRISIL B column, I told D is for default. Directly, you should take it as default. So, if a loan under 3 years transition matrix, if a loan is classified under CRISIL B column, may 58, I mean, to continue to be in the B only in the later also, in the next 3 years, only 58.44% chance is there. Correct. Now, those loans today at B, okay, to become default, that is D, there is 21.91 percentage, there is a probability, because they have not done it like today, yesterday, taking by 1 or 2 companies information, they have not done. They have done their research. Obviously, that is a researching company. Correct. Now, they have done a great work, obviously. That's the information they have given, trustworthy information. Yes, you can go ahead. So 21.91 percentage, there is a probability of default. And with our recovery rate expectation, my loss given default is going to be 0.75. As I said, 25% is recovery, 75% is a loss. So I said exposure at default 23 lakh into probability of default 21.91 percentage as per this table into 1 minus recovery, that is nothing but 0.75 default. When I multiply all these things, I get 3,77,000, which is clearly written on the screen. 3,77,948 is my ECL in the given case. I hope some idea, overall idea, you got it. Correct now, right? I hope. So entries are very simple. It's like a provision entry. That's it. Provision entry in the sense it's going to hit my PL. Yes, I mean provision for your ECL you call, allowance for allowance for doubtful debts you can call it as, to a provision you make it. Okay, that provision is not a liability. It should be reduced from the asset. That's all. Normally, if it is a trade receivable, what do? You'll write like either provision for doubtful debts or allowance for doubtful debts. What is the journal entry you will do it? Yes, it's going to hit my P&L expense, and the credit is going to be reduced from the respective. I don't reduce it from the asset. I'll just write as a allowance or provision name. I'll keep it. But in the financial statements, I'll say 23 lakh minus 3,77,000. My net presentation will be given. Okay, right. Nothing different. That is normal provision journal entries. Okay, situation number 2. Situation number 2, I should not go with the 3 years matrix because it was B and it is B. There is no significant change in the risk. So B to B, what is the now situation? Right, it is 1 year matrix because B to B, as we already concluded, 12 months ECL is supposed to be computed. So yes, read the column CRISIL B column 81.33 percentage, which is highlighted. Correct na? In the same horizontally, you should read it. I said, right. So 1 year matrix may, what is the probability within a time of 12 months, which is sitting in B rating, correct na? That has a probability of 8.27 percentage to be defaulted. Okay, within 1 year time it can probability. That's all. We apply 8.2, I mean same calculation, that is 23 lakh into 8.27 percentage into 0.75. I will apply, then whatever comes, yes, just a number change will happen. But I right, very happy that at least you understood, right, stage 1, stage 2, stage 3, when to go with full time or lifetime ECL or the 12 months ECL. And one more very clearly said by IFRS 9, if it is a trade receivable. Okay, see, generally trade receivable, what is the credit period? Either 30 days, 60 days, 90 days. Correct. Na? It cannot be yes together like 3-4 years ka, it will not be there. Yes. So since it is right, 30, 40, 60, 70 something number of days will be the credit period. That's why. Right. What they say, lifetime ECL, they will tell. Lifetime ECL also is obviously life itself is short term. Correct. Na? So 90 days or 120 days max to max. 120 also very, I mean, rarely you will see the credit term. Right. So standard says IFRS 9 says you should do that one. Right. I am going for the one small Excel presentation. With that, I will just, I may take another 5 minutes. I hope is that fine? Excel computation, I have done it. I just thought of this is a very basic explanation. Right. I may take your time little more.
Please go ahead. No problem.
Okay. Right. Thank you very much. So this is, see, this is not something, have you invented something? No, no, I have not invented any great thing. This is a simple calculation. As I told you, for trade receivable kind of situation, you don't need to invest time and money, too much of time and money. One simple method. You can follow this, or you can follow many other methods are there in the industry. All the methods in the given time may covering. It's not that easy for any faculty. Okay. Just, it's not an excuse, that is practical problem. Done. See, DPD means days due, days past due. That way, correct. So at the same time, period coverage. I have taken here in my example only 2 years in Excel calculation. Okay, this
Ravi,
is,
your Excel is not visible. We are still seeing your PPT.
oh, sorry. Okay, once again, I'm sorry. I think, oh, done. Got it. Yeah, is it okay now, visible? I'm sorry.
No, still now we are in Excel. Yes.
Okay, right. Thank you.
No.
Yeah. So DPD, days past due. This is a short word. Fine. And so generally, what is the better period to get the probability of default? 2 to 5 years will make sense. Like just if you take 6 months data, no, that won't give the behavior, okay, of the asset, of the default. That's why generally we suggest like 2 to 5 years information should be taken. Done. Okay. So here, just what did I do here? So April 23, these are all just rough number, nothing related to any company, just floated some numbers. Fine. So April 23, month on month information I gave. My trade receivables. Okay. About, I mean, DPD in the sense over and above the due date. I mean, you cross the credit period, the people have not paid. So it is a example. First column, I'll just read it out like this. My total receivables are, I mean, which are crossing the DPD. I mean, 0 plus DPD is equal to like 42 lakh 71,000, right? Out of that, which are in the bucket of 0 to 30 days, okay, and the 31 to 60 days, right? And I have taken an assumption, if anything crossing DPD above 60, I will consider it as 100% default. That's all. My PD is equal to 100%. I don't want to break my head here. Okay, right. So now how do I read it? I'll just highlight it to explain. So April 23 means April 30th. You should take it, obviously, end of the month. So my, which is sitting in the bucket of 0 to 30, that is moving to the next, I mean, May month. It is coming not correct. Now, suppose nobody has paid. Out of 23 lakh, nobody has paid. Then this number would have been 23 lakh only. I hope you got it. Correct. Na? But it has become not 23 lakh. It has become only 11 lakh 75,000. So there is some collection. Yes, obviously there is some collection. It has become less perfect. So now what is that I have done it in simple example. I have taken a ratio. What is the, I mean, flow rate, I can say, or percentage of default, you can call it here. All right. What is 11 lakh 75 divided by 23 lakh I have applied. So there is a possibility of 51% is default. Correct. Na? So the remaining amount, people have 49% is paid, 51% is possibility of default. At the same time, correct now. So 12 lakh 51,000 has become 3 lakh. So there is a collection here. So which is sitting under the DPD of 31 to 60. That bucket, second bucket, I should say, is there is a probability is 26% is there. Like this. And again, subsequently that it's not 100%, but I said anything above 60 days, about DPD, correct now. DPD in the sense you understood already, credit period is gone. Over and above the credit period, these numbers are coming. Okay, so I am taking it as 100% in my calculation. That may be, that is a professional judgment. You can take it different. No, I want to apply little, one more column also, one more row also I want to apply. Please go ahead and you can apply it. This is in my just simple calculation. The same formula I have just applied it for all the months. See, I have taken it till March 25, 23 to March 25, 2 years period I have covered. It will give some better picture. Okay, so now what is that I did simple thing, I have applied the average. Okay, average I have taken, simple average, plain average formula I have taken. So I mean, how do you read this 54%? If any number is sitting in the 0 to 30 days DPD, there is a probability of 54% chance for the default. Okay, it will not come. Okay, if it is sitting under the next situation, it's 42. Generally, it will be Volta, but it's okay. Just I told you, numbers are floated, not the actual numbers of any company. Okay, right. So 42%. And as I already told, above 60 to 90 or 90 to above anything is going to be 100%. We are going to take it. That is our professional judgment. I just simply applied the bucket movement from one bucket to another bucket. What is the probability of default? Okay, so same numbers of whatever here I have just linked it. I just took it from that place only, 51, 42 and all etc. information. Again, for this average I have computed, just keep it like this is nothing but 71% of total average. Right. So 74% is what? Default. Probability of default when I say. My recovery another way around also I can say 26% I am able to recover indirectly. 1 minus recover, I mean, PD is nothing but recovery. Let's hold it that way, right? Very simple calculation, as I said. So what is exposure at default? Exposure at default is nothing but my 31st March balance, because that is my balance sheet date, whichever your December or whatever. The same numbers of 40 lakhs, 6,000, I just have put it here. That is my EAD, exposure at default, right? So PD, yes, the above numbers I have again copy pasted from here. Correct, na? Yes, I will multiply these. I can directly multiply with the LGD. Simply just for information, I just multiplied it here. Okay. So this is unadjusted provision. It is not the closure ECL. Fine. So I just multiplied and we got these numbers. Unadjusted provision, you can call it. This is just not a language of the standard. Sorry. Okay. LGD, how do you calculate? Yes, LGD, how do I calculate? Just observe here. If there is any, right? Say example, my gross exposure. Yes, gross exposure is nothing but 40 lakh, which is my total, right? So if there is any, sir, I mean, say example, the other party has already given the advances or something. So that means some asset is with me. Correct. Now, so obviously I will not give them back. If they don't pay me this, or I will adjust it with advances. Assume that kind of recovery I am telling. These are all obviously unsecured trade receivables. Obviously mostly unsecured. So what is my net exposure after adjusting with the other assets which are under my control? If I say yes, that is going to be 28 lakhs 6,000 is going to be net. Okay. What is your LGD? How do you calculate? Yes, it's very simple. Okay, right. D59, yes, which is my net exposure. Okay, divided by the gross exposure into the probability of default. If I apply, this is 52% is going to be my recovery, I should say. Okay, 52% is going to be lost. Right. So now the question is, what is ECL? What is ECL is nothing but unadjusted provision. Into LGD you can directly apply. Yes, like this we can determine. Right. Now, if you want to determine on the percentage of this is just an information, nothing required. Right. E method also you can apply directly 28%. Suppose like this calculations you have done it for 2-3 years. Okay. Already percentage on EED. At third year you can take it as a right 28 average of the next 2-3 years also you can apply it. This is one simplest method, right, where you don't need to apply great knowledge. Right. There are so many kinds of methods, so many different. I mean, CRISIL also will give such for some kind of trade receivables, not for everybody. Some percentage will be given from the report. Some percentages you can catch it, and directly you can apply with respect to few cases, not in general. Okay. I think this is my small presentation. I'm done with my session, my part. Right. Let me know any questions, please.
Thank you, Ravi. Any questions you can type on? Satya, are you there?
Yeah, I'm there.
You have to cover something today, or you'll be covering tomorrow,
I'm
because
done.
already.
We are done for the day. So tomorrow we are taking the balance topics.
Perfect. Thank you very much, Ravi. I mean, after a long time, yesterday I could not attend it because of some, but today I'm telling you the way you have covered it is phenomenal. I mean, the way you cover the topic is something as a teacher. I mean, as a teacher, I've seen people covering it. Thank you very much for this session, and I'm sure this will come up in the chat. It is coming for you. all the people who have attended can say it's an excellent session, a great session. We look forward to welcome you in person in one of the events in Dubai. That is, I can say you, if you have your calendar available, we'll call you in Dubai because I loved your session. Thank you very much for that.
Thank you, JP. Thank
Jay
you,
bhai, I think I
thank you,
can see
ICO
Abbas.
Dubai.
Abbas Saab is
If Abbas Saab is here, I'd
also
love to
there.
have Abbas Saab here.
Yesterday you
Abbas
were
Saab.
asking. Yeah. Abbas Saab, are you listening to us?
If you are available,
Yesterday,
we will
actually, we
hear from you.
correct.
I think he is there, but he's not unmuting himself, so maybe he's busy
Yeah, I
with
can
something.
see his name here.
Yeah, I can also see it.
Yeah, maybe.
So no problem. That's fine. I think he's busy with something. So, but thank you very much, and looking forward to see you for the last day class tomorrow. And I can see an active participation. 100 people at 8:30 after office hours. If you are there, that means Ravi, you have done something really great. Satya, thank you for bringing Ravi to the chapter. Balram, thank you for bringing both of them together. And I can see Abbas sir now. I can see his beautiful face after almost 6 months. Abbas sir, how are you?
So I'm good. I'm actually not in Dubai. I'm in America.
I know, sir.
Right now. Yes, sir. Thank you so much for inviting me. It's a beautiful session. I just want to tell everyone that this is the most difficult topic under IFRS. And when the first time financial instruments came out, the chairman of the ISB was David Tweedy, Sir David Tweedy. And he said that there will be blood bath when you try to implement it, which is rhetorically what he said was there will be a lot of complications. And he also said that anyone says that they know everything in and out, they are probably lying. So it's a very complicated, it's completely, like the way that Mr. Ravi and Mr. Satya have done, I think it's commendable. Thank you very much.
Thank you, Abbas Saab, and looking forward to see you back in Dubai in some time. It's almost
Yes, sir.
6 months we have not seen you. But thank you very much for coming on the camera and looking forward to
Thank you, sir.
seeing.
Thank you,
everyone. See you tomorrow, same time, 6:30. Amit, you want to conclude something? Please go ahead.
No. That's all you already said. So rest well, reflect a bit, and yes, don't forget to join sharp on time. So and have a good sleep and good rest. Thank you so much and take care. Good night.
Thank you.
Yeah, thank you all. Good
Thank
night.
you.